I'm Doris. I'm here to share with you about my stock account. Let's take a look at my account today. Today, SQQQ rose for 0.98% during the market. Today, SQQQ rose for 2.39% to 19.24 during the market, and United Natural Gas also made a loss of 0.98% during the market. Right now, the net asset of my account is $68,037.48. The market generally closed lower as the bond interest rate yield rose to its highest peak in the decade. Dow Jones Industrial Average decreased 1.07%. Nasdaq Composite decreased to 0.82% to 13,679.04, and S&P 500 closed down 0.79% to 4,411.59. Today, the tech industries led the loss, whereas only the consumer electronics and software infrastructure closed up slightly. Expectations of interest rate hikes in the U.S. market have skyrocketed. The 1-month correlation measure between the 10-year Treasury yield and the S&P 500 turned negative for the first time in 3 months, implying that both Treasuries and stocks were sold off. The sell-off boom of 2022 seemed to be repeating itself. The hot U.S. labor has triggered a surge in the expectation of interest rate hikes, and the U.S. stock market and bond markets have suffered a bloodbath. On Thursday, U.S. ADP unemployment report showed that the U.S. private sector employment increased by 497,000 in June, more than double of market expectation of 225,000, far exceeding the previous value of 278,000 and the largest increase since July 2022. It raises expectation that the Fed will resume interest rates because the inflation seems to be continuing. The latest pricing in the futures market shows that traders expect the probability of a 25 basis point rate hike by the Fed in July to be close to 92%. This caused the U.S. stock and bond markets to plunge again. On Thursday, the yield on the 2-year Treasury note surged to its highest level since 2007, and the yield on the 10-year Treasury note surged above 4%, reaching last year's peak. The calming the U.S. stocks have also begun to waver, with CBOE volatility index soaring to its highest level since the bank crisis in March. The index is a fear index that measures the expected volatility of stock prices. While fiery labor data dispelled fears of an imminent recession, subsequent trading moves also showed that the Wall Street is not pricing higher interest rates for longer. On Thursday, Dallas Fed president also said further interest rate hike may be needed. Worst of all, the 1-month correlation measure between the 10-year Treasury yield and the S&P 500 turned negative, implying a sell-off in both Treasury and U.S. stocks. The consultant and macro intelligence, 2 partners, reportedly said, "The problem is that for whatever reason, the economy is not slowing fast enough. The Fed seems to have more to do. If that's the case, a lot of market is a bit offside." However, some analysts believe that despite this week's market volatility is still significant and confidence in hedging strategies nearly collapse. In credit market, the spread between junk bonds and U.S. Treasuries remain near the year's lows, suggesting that the crisis has not yet hit the broader market. Head of U.S. interest rate strategist Associate General reported that the more the Fed raises interest rates, the worse the recession is likely to be. She advises clients to be a bet on the steeper yield curve, where short-term interest rates are likely to fall relative to long interest rate yields. But she also acknowledges that it's not an easy deal due to market volatility. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.